From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Farrow. It's a battle for the renaissance of the equity bulls. We're just picking up 0.5%. Uber flies high on a $7 billion buyback. Countdown to the Open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Up in the show, futures rebound after the worst inflation day decline since 2022. That hotter than expected CPI erasing the last remnants of a global bond rally. And whoops, fat finger, that error sending lift shares on a wild ride after the earnings. We begin with the big issue of the day. Were Fed rate cut hopes go to die?
I'm not sure who was expecting rate cuts to really take place in March at this point.
This is a bit of a bruising CPI report.
The number was a bit hot.
It's not good news.
There's a lot of things that the Fed is not going to like.
It does complicate the messaging and the decision making for the Fed.
We now had to punt on rate cuts further into the year.
I think the first rate cut is in June.
Late this spring or in the summer.
I won't say that the June cut is off the table yet.
The Fed will not be cutting rates as much as the market expected.
We only have 3 rate cuts this year.
3, maybe 4 cuts.
They certainly don't seem to be in a rush, and they don't look like they need to be in a rush.
We still have a long data between now and May, and we'll see how the whole totality of the data pan out between now and then.
Well, joining me now about those dreams to discuss everything is SocGen's Subhadra Rajappa and Nuveen's Tony Rodriguez. Good to have you both with me. I love what UBS sent to my inbox this morning. It was hashtag hot, not hashtag hysteria when it comes to the CPI. Tony, good morning. You co-chair the investment committee. Was it a stable conversation? This is one jolt, or was it a mild touch of hysteria on the spike yesterday in CPI? Good morning.
Good morning, Manus. Good to be with you. It was definitely a piece of information that complicates the picture in terms of expectations for the Fed. So you saw the market price out a couple of cuts. If you look at PCE, 6-month annualized, still running at 1.9%, well within the Fed's expected, hoped for target range. CPI a bit hotter. So it does complicate the story for the Fed. From our perspective, as we're looking at the Fed, we're thinking about their ability to cut being driven by 2 things. One is the decline that we've seen in inflation that we expect will continue over the coming months. And number 2 would be any potential slowdown in growth. What's really changed over the last month in our minds is that the growth story is much stronger than people expected coming into the year. So any kind of slowdown to a 1% growth pace in the second half of 24 seems far less likely. So the need for any cuts related to slow growth seem to be off the table. With respect to weaker inflation, there we think the number of cuts that might be required by the Fed is more in the neighborhood of 3 or 4, which is what the Fed or what the market is now back to pricing in. Somewhere around 3 to 4 cuts starting around the middle of the year, whether that's June or July, and that's more consistent with what the data has been. So the inflation story, definitely at the margin, worse than it had been a month ago, but not materially different in our minds.
Well, it's certainly the market finally coming to the heel of the dots put out by the Fed. Subhadra, good morning. You would also remind us that we must not venerate or worship or rely upon 3-month and 6-month annualized inflation readings. You say too much store of value has been placed on those. So it's a healthy jolt.
Yeah, for sure. I mean, I think that this brings home the point that Chair Powell was trying to make in the 60 Minutes interview, which is that we should probably be not just looking at 3-month or 6-month annualized core PCE inflation, but also look at the 12-month or the year-over-year core PCE. And, as Tony was pointing out, and I'm very aligned with what he said, inflation is definitely on a steady trajectory towards disinflation. I wouldn't read too much into 1 month's inflation print, but really what has surprised us fundamentally is the strength in growth. I mean, the third quarter and the fourth quarter were extraordinarily strong on the growth front. And that momentum seems to be carrying into the first month of the year and perhaps into the first quarter. And that's really what's changing our view on what the Fed will deliver for cuts for this year. So I think the data is definitely relatively strong. The Fed is locked and loaded. If they need to cut rates, they will, but there's no urgency for them to act.
No, they certainly got the cover that they need now in a bond market that has been reawakened the bears, but perhaps not the vigilantes. Well, the rate cut expectations are in focus on that hotter than expected CPI print. Let's turn our attention to the slate of Fed speak this week. Bloomberg's Mike McKee is with me. Mike, I mean, it's a roster that could help validate the cover story on the back of the CPI. This is where they will have to say, we don't have the confidence to cut rates or not, because we will focus on the PC. Mike.
Well, it's really interesting, Manus, because after the CPI, you had a lot of analysts commenting. You showed them at the top of the show, but we haven't yet heard any Fed officials. We did hear this morning, just a short time ago, from a former Fed official, Eric Rosengren, who was the president of the Boston Fed, who had a very counterintuitive take on all this, saying the market overreacted to the CPI report. While above analysts' expectation, monetary policy is not set to analyst expectations. Nothing in the report indicates anything other than a continued trend toward lower inflation. A March cut was already off the table. This will have little impact on May. Kind of interesting. Here's what the market is looking at that has them thinking the Fed may be either backing off on cuts or pushing them out. This is the supercore, core services ex housing, the number that Jay Powell likes to look at. And if you look at the far right there, you can see the big increase. We take out housing, and it certainly suggests there was a lot of inflation in the service sector that we hadn't seen in recent months. And you drill down into that using the Bloomberg ECAN function, and we can see that housing is still a problem. The thing about housing is that the rent numbers have been going down, but housing prices, as you can see again on the right, still going up at a relatively quick pace, and that also puts a lot of pressure on the CPI. So there is inflation, but there is also concern about what's going on with the rest of the economy. You look at the calendar for today, and you'll see that there is some Fed speak. We've got Goolsbee coming up in about 20 minutes. Michael Barr probably talking about bank regulation. That'll get a lot of interest on Wall Street, but not for policy reasons. And then tomorrow we have, my goodness, a very, very big day with all kinds of numbers that could impact the Fed, including retail sales. And then on Friday, PPI. That'll be interesting because we'll see some numbers going into PPI from the CPI and into the PCE report, which comes up at the end of the month, particularly for healthcare. So a lot to watch still, and maybe that's why Eric Rosengren is saying this isn't going to have a lot of impact on when the Fed cuts rates.
OK, Mike, thank you very much. We'll be tuned in for that Fed speak over the next 24 hours. Subhadra Rajapaksa and Tony Rodriguez are my guests this morning. Subhadra, can I bring it back to you? Because John Arthurs has a lovely piece on the Bloomberg terminal this morning, said, first, it was transitory. You will both remember that. We endured that for quite some time. It was never transitory. Now to intransigent. That's the risk, isn't it? When you look at the data that Mike has just put up in front of us on housing, on the owner's equivalent rent, it depends where you look in the country. Do you think we could be going into an intransigent period? The last mile is not going to be an easy one-way ticket ride, is it, Subhadra?
Absolutely. And I think that that's the point that the Fed has been emphasizing, and a lot of economists have as well, is that it's probably easier to get inflation from very high levels last year, close to like 9%, down to maybe 2.5% to 3%. But getting it to 2% or below, or I should say back to 2% is going to be a lot more challenging, given the fact that the labor market's extraordinarily strong. You're looking at wages that are high and sticky, and so far we've really not seen any sort of an indication that the labor market is cracking. So I think that last mile is definitely going to be very challenging. And also, I think what's interesting about the super core discussion that Mike was pointing out is that at least in CPI, the gains were very broad-based. But what the Fed really looks at is core PCE. And it's not clear that a lot of these components, especially things like shelter, are going to feed into a much hotter core PCE. So we'll be looking towards core PCE to see if that actually translates to higher prints over the next 3 months.
Well, Tony, let me take that to you. The risk is now very squarely in the camp. If we extrapolate what Subhadra has said and what other guests have said this morning, the risk is a hotter, slightly hotter, spiky PCE, core PCE. That could reignite the argument that you break the 425 level and you could retest the upper fours. Is that a material risk? Should I be positioning for that? Are you tempted by the bears, or are you sort of saying, look, Manus, 425, 450, I incrementally add duration here?
Yeah, thanks, Manus. I do think that our view has been that fair value for the 10-year around this time is somewhere in the 4% area. So as we get into the 4.25 to 4.5 range, we do think that's an attractive area to either begin to close out any duration short positions or begin to establish some longer duration positions, because we do not see a reacceleration in inflation. But I 100% agree with Subhadra that the last mile is going to be very difficult. Our view is that while core PCE has gotten down to 2.9 very quickly, we were at 4.2 back in July, our expectation for the end of the year is that we only see maybe another 20 to 30 basis point improvement in that level. So it's going to be well into late 2025 or 26 before there's any hope of the Fed achieving their 2% target in our mind. So definitely not transitory, definitely sticky, definitely a difficult last mile. But we don't see the reacceleration that would drive the 10-year back towards 5%, where we hit, last fall.
Okay, well, it was worth a try to get you to break the range. Subhadra, you're not having any of it. You're 420, you're 375 bid, 425 offered. When you see movements like yesterday in the bond market, this is a very classic bond and equity market moment of overreaction. So for you, we still stay in the band 375, 425.
Yeah, that's our view. I agree with Tony. I think this is a very buy the dip environment in the bond market. If 10-year yields do get between 425 and 450, I think that'll be a buying opportunity. The real reason for that is because we're at the end of the cycle, and the Fed has clearly told us that the bias is towards lower yields. So, really, this is an opportunity for investors that missed out earlier on to get into long positions in bonds to kind of, buy the dip, if you will. So that's kind of what we're looking at. But broadly speaking, given the inflation dynamics and how strong the economy has been and how strong the employment picture has been, I think 10-year yields probably stay between 375 and 425, at least for the first half of the year.
Well, let's be fair. They don't need to telegraph cuts. I mean, it's not as if we're going to have a historically bad reaction. We'll have traveled and arrived probably when we get them, but they don't need to telegraph those. Tony, can I ask you then, we have this sort of no landing, soft landing scenario. We have perhaps much less rate cuts than we anticipated or we were aggressively pricing before Christmas. We've gone from 7 to 3. What does that do to the credit to bond scenario? Because you have a firm economy in theory, which shows to be robust. Do I lean more into credit then than I do into treasuries?
Manus, it's a good question. From our perspective, the real danger here is in the tail risk, that you either get a very, very hard landing, you end up with 10 or more cuts, or you get 0 cuts because inflation is reaccelerated. In that range of 3 cuts to 6 cuts, we think the outcomes are generally similar in terms of capital market returns. But the fact that the economy has shown more strength than had been expected, that is very supportive for credit. So we are very comfortable from a credit risk perspective in corporate credit, for example, emerging markets, in high yield leveraged loans. But the higher for longer Fed, meaning fewer cuts this year than had been expected, that will eventually, we think, begin to really impact the lowest quality companies and borrowers. Think of the lowest quintile in terms of income for consumers. Think of the lowest credit quality companies. Think of the lowest quality segments of the real estate markets. Those higher financing costs are going to impact their ability to service that debt So we're a little cautious about going into the deepest end of the credit risk pool, but we do think that kind of the higher quality segments of below investment grade and the broader investment grade credit markets are well positioned given the health of the economy as we look at over the next 6 to 12 months.
Okay. Thank you very much both for joining me. There are moments in these markets where you just sort of reflect on what Churchill said. You've never had it so good. Let's hope it turns out that way. Subhadra Rajapaksa and Tony Rodriguez, because we're positioned with an inch of our lives. Let's talk about the stocks ahead of the opening bell. What a belter from Airbnb. Abby, good morning.
Well, we will be taking a look at Airbnb, but first, let's start off with the wild, wild ride of Lyft. So shares are up 20%, but that pales in comparison, of course, to the 67% higher yesterday in the after hours. Now, of course, there was this strong quarter, the outlook, but not quite as strong as the 500 bips margin improvement, that quote-unquote clerical error that had the stock at one point up nearly 70%. Instead, it's a 50 bip improvement. Again, though, it was strong quarter, 65 cents versus 7 cents, inline revenues. There's a 14% short interest, so some of this could be a squeeze. Uber going along for the ride, plus they have unveiled a $7 billion buyback. Robinhood up 14%, another short interest there, not quite as high, up 5%, but maybe a little squeeze. Revenue a bit better, so perhaps better than feared. Some analysts, though, saying that this quarter was solid. Investors seem to agree. And then finally, there's that Airbnb you were talking about, the odd stock out, down nearly 4%. They put up a mixed quarter. Analysts like it, but they're talking about the first quarter being a bit tough, that comps and the standpoint and Easter tough. $6 billion buyback. Brian Chesky, talking about reinventing the core outside of the core. But right now, investors want more.
Abby, thank you very much. Those bullish investors coming back to the S&P 500, will it last? We'll give you a lift in a moment. We're all revved up.
This was an episode of Saturday Night Live, except it was real. And I think that the scary thing here is just that it actually got through.
Brilliant. An episode of Saturday Night Live. More on Lyft's massive mistake in just a moment. Unbelievable on Bloomberg.
This was an episode of Saturday Night Live, except it was real. And I think that the scary thing here is just that it actually got through. And I think it's been really a comedy show that we've seen at Lyft for years right now. And this is, even though it was a good quarter, it overshadowed by another black eye moment for Lyft.
Brutal assessment by Dan Ives this morning on Bloomberg Brief from Wedbush, talking to us earlier today. And Lyft shares spiked after the ride-hailer said that margins were expected to jump by 500 basis points. However, the number was too good to be true, and the company corrected it to 50 bips an hour later on the call. Team coverage on this, Ed Ludlow in San Francisco. Alongside me here in New York, it is Mandeep Singh. Ed Ludlow, good morning to you. The highest annual ridership ever, but that headline got subsumed by this error. Was it a Saturday Night Live brutal attack?
Yeah, I mean, it was a wild ride, and the tale of the tape is simply that the deck or the shareholder letter stated margins would expand by 500 basis points incorrectly. Erin Brewer, the CFO, goes on the earnings call and says 50 basis points. An analyst calls them out on it and says, what's going on? And they acknowledge that it's a clerical error, that the press release was incorrect. But what's astonishing about it is if you look at the pre-market gains, and Dan Ives pointed to this, it was a strong quarter. Ridership in the quarter gone was slightly below, but the gross bookings outlook for this quarter is strong, even at the low end of the range, kind of meeting consensus. And so Lyft still demonstrated that in the wake of the post-pandemic era, rider growth is there, and they're being competitive just against a bigger peer in Uber that has a much more diversified business. I can't get over the pre-market gains because it's just a weird situation.
It is, but I suppose maybe now is the day that we have 24 hours to reflect, and we look a little bit deeper into what is the business. Although Wedbush Securities were scathing in the least about what went before. Mandeep, good morning to you. So here we are. I'm an investor. I'm long of this stock, and suddenly I'm 65% in the money, and it's visceral. It turns around. I traded on this information pre-market. What is my retribution?
Well, so in this case, you have to put it in context. I think it wasn't intentional to begin with, and they fixed the mistake pretty quickly on the call. So, look, the management team is new, both the CEO and the CFO, and it does hurt credibility, I would say, given it was in the press release. And Lyft does have a history of, surprising investors about their margins. So if you go back in time, their gross margins actually collapsed a couple of years back from mid 50% to mid 30%. And that happened because of insurance reserves. So it's a little surprising that, it happened in the press release. But at the end of the day, it was a mistake. And I think investors will move over it.
Yeah, everybody can make mistakes. It's still interesting, as Ed says. Gentlemen, thank you very much for joining me. Taking that story apart, you've got Lyft up 23% pre-market, and also Uber. Uber is up for different reasons. It's up 7.6%. You have got, of course, a share buyback there of $7 billion. So that's sort of driving that one. Gentlemen, thank you very much. And be sure to stay tuned to Bloomberg, because we have the Lyft CEO, David Risher, joining at 11 a.m. Eastern Time. Perhaps he can respond to some of the heady calls against the delivery yesterday. Coming up, your morning calls. Clear Harbour's Aaron Cannon joins me. His outlook on the markets. Traders are continuing to push out their rate cut expectations. The bond bears have been reawakened, and we are down to 3 rate cuts in 2024. Good morning from New York. Obviously, all the buyers of the dip turned up today, from the breadth of the Russell 2000 up 1.4% to the Nasdaq trying to claw its way back. You've got Uber and Lyft up pre-market. One is a buyback story. So again, yesterday's price action on the downside, as we saw yields spike to the upside, perhaps was just a temporary interruption in the risk narrative for equity. These are your morning calls on what the analysts are saying on Wall Street. Moffett-Nathanson upgrading Lyft to neutral after their earnings. The earnings pointing to better than expected cost discipline. Up next, HSBC upgrades Hewlett-Packard to a buy, expecting better margins and a strengthening PC demand. And finally, Piper Sandler upgrades Citigroup to overweight, seeing an attractive buying opportunity following the recent declines. A real belief in Jane Fraser's turnaround story. Coming up with me, Clear Harbour's Aaron Cannon joins me for the implications on that hotter than expected CPI, the conversation on whether it was a one-off blip, and really if the Fed will focus squarely on PCE, and we are perhaps overreacting. #hysteria to the hot CPI. Good morning from New York. Small bounce back in these equity markets this morning. The narrative from UBS is, yes, it was #hot, but #hysteria reaction in the bond market and the equity markets, because those owner equivalent rents perhaps distorted it. So equities are opening on the upside, both in the S&P 500 and the Nasdaq. We have some breaking news headlines, the beginning of Fed speak across the terminal. Mike McKee joins me now to tell me what Goolsbee had to say. Mike, good morning.
Good morning, Manus. We've got some comments from Austin Goolsbee, the Chicago Fed president, that track what former Boston President Eric Rosengren said at the top of the hour when I brought that to you, that the Fed's policy is quite restrictive now and inflation can be a bit higher. But that doesn't mean it's still not on a track for 2%. Goolsbee goes on to say that he doesn't support waiting until inflation reaches 2%, which may be, for the CPI at least, which may be a hint to the markets that they overreacted yesterday. He doesn't believe the last mile of inflation is going to be the hardest, and he says that the same low inflation print every month would not be the kind of thing you would expect to see. So Austin Goolsbee is suggesting that they think inflation is still on a track. It wasn't a terrible number yesterday for CPI, And he points out that they follow the PCE, not the CPI, and PCE is much closer to 2%. Manus?
Yeah, and productivity has rebounded much faster, Mike, than he had expected. So again, this is all about guiding us as best they can. Perhaps our overexuberance on yesterday's CPI, hot CPI number, we were perhaps a little bit, according to UBS, hysterical. We're just seeing two-year yields drop to 4.59. If you look at a one-day chart on that, she's going right the way down. Mike, thank you very much for breaking those headlines from Austin Goolsbee. Let's turn our attention back to the equity market. Some stocks squarely in focus. Lyft shares rallying after their earnings, but still a far cry from the earlier gains in the mid-60s. That clerical error sent the stock higher by 67%. Abigail Doolittle is with me now. Now we focus on the headlines. Abby.
Well, 5,500. Who's counting, Manus? Well, apparently the investors who first read that press release that you just referenced suggesting that they could see a 500 BIP or 5% huge margin expansion this year. Well, that's not the case. Shortly thereafter, on the earnings call, management cleared that up, that it's 50 bips, which is still respectable, but the stock quickly came down. Today, though, we have it up 29%, the best day soaring since November of 2020. It was a very solid quarter. Beyond that, some investors and analysts are saying that they have lost credibility on that, but they fixed it pretty quickly, at least in terms of saying what was what. Their earnings beat 65 cents versus 7 cents. Inline revenues, there is a 14% short interest, so some of this could be a squeeze because they also talked about having the highest annual ridership that they've had. Now, Uber also up sharply, up 8%, the best day since May of last year. They announced a $7 billion buyback, the first ever. On the year, though, it's a little bit lopsided. Over the last year, I should say, it is Lyft, or excuse me, it is Uber that's up more than 100%. Including today, and Lyft up closer to 30%. But after yesterday's good quarter, putting aside that error, Manus, maybe Lyft is going to start climbing more on Uber's trails.
Yep, and that's a heck of a move by Uber, isn't it, on that buyback. Abby, thank you very much. Tune in a little bit later on, the interview of the hour, 11 a.m. Eastern. We'll have David Risher on Bloomberg TV. Let's turn our attention to Airbnb. The company saying demand may not be as robust as last quarter. The CEO prepares for a pivot. Ed Ludlow tells me why. Airbnb. So are you a hotel man or an Airbnb, Ed?
I'm a mixed basket. I mean, Airbnb is interesting, and it speaks to the story because right now, Airbnb is pretty one-dimensional. It does one thing. What the market is reacting to, down 3.9%, biggest drop, or on track for the biggest drop since mid-December, is this idea that Brian Chesky is trying to tell investors Airbnb is going to be something different in the future. The integration of more third-party services. We're not really clear on what AI looks like in the Airbnb context. What's interesting is the guidance for this quarter is revenue of $2.03 to $2.07 billion. Even at the low end of that range, it's still exceeding what the street was looking for. Really strong quarter in the December quarter, but it's that even if the numbers are good for the March quarter, the narrative is what's worrying. They're saying that we won't see the same growth quarter on quarter, nor from a year ago, and it's a simple case of lapping tough comps. Because if you think about 1Q 2023, that was a real hotbed of travel post-Omicron, corporate and leisure travel in key markets like North America, but also in continental Europe as well. So wow, the decline's really accelerating, down 4.8% now. This is where we're at. Slower growth, but also trying to tee up or tease this idea Airbnb will look different in the future, but we don't really know what that looks like.
Yeah, I mean, what role does AI have in your checking in, as you say, to a property? But let's see how that evolves, because that challenges all of our thinking. And thank you very much. On Airbnb, the drop-off accelerates there. On a different story, Robinhood. Now, the revenue surpasses the estimates with deposit growth outpacing last year. Isabel Lee has the latest there. Wow, up 12.5%. Isabel, good morning.
Good morning, Manus. It's up 12.5%, but earlier when it opened, it was up 16%. That's the most since August 2022. And results were strong all over the board. We have a surprise profit as well, driven by a higher interest income and also a rebound in trading. And analysts in general were very impressed. We have KeyBank and Piper Sandler lifting their price targets. We have revenue that top estimates, jumping 24% year over year. And executives also said that deposit growth, to your point, is outpacing last year. In fact, CEO Vlad Tanev said that the growth that they've seen in the first half of the first quarter already outpaced the entire fourth quarter last year. He also touted their increasing market share and, of course, their efforts for their global expansion. Net deposits were $4.6 billion in the fourth quarter. Crypto revenue was $43 million. That also surpassed estimates. And as we know, we have spot Bitcoin ETFs that launched last month after a years-long crusade, almost a decade actually. And Robinhood was one of the first to immediately put those in their platform and made it available for their customers. And of course, the enthusiasm around those ETFs boosted the price of Bitcoin to a two-year high. It peaked to around 50,000 in the past 2 days. And as we know, declining interest can support growth, which is why Robinhood said that from a headwind, this will be a tailwind for them. And shares are still increasing, up 13%, Manus.
Okay, Isabel, thank you very much. Let's turn our attention to MGM, the casino company, eyeing some acquisitions in the online gambling space, as well as live dealing. Simone Foxman has the details. Simone, where are they going?
Yeah, man, it's live dealing. So this is folks sitting live in a place like Las Vegas, celebrities and the like, dealing to online customers. This has turned into a big business, billions of dollars for some of MGM's competitors. And now it looks like MGM may be very close to its own acquisitions. CEO Bill Hornbuckle talking about how the company is on the heels of a deal we've talked about and had a vision of broadcasting live games from Las Vegas to the rest of the world. So very much seems like they're in that space. Also talking about a sports betting tech company that they want to make an investment in. Hornbuckle said he's on his way to Brazil later this month to try and explore a JV there. But we look at the shares today, they're down over 6.5%. And part of this is because what's happened to regional revenues. That really seems to be the focus, even though it's just about 20% of the company's revenue overall, and it did overall beat on a lot of its major metrics. Barclays calling some of its regional revenue well below consensus estimates. Net revenue was down 12% year on year. And so this standing in the way of progress that we saw in Las Vegas and in its MGM China unit. Very strong results there. But, you know, you heard Ed talking about the future for tourism and where we go from here. Maybe that overall sentiment is something that is weighing on MGM today as it reports some weak performance in this segment of its business, Manus.
Okay, Simone, thank you very much. Simone Foxman there with the very latest on MGM. My guest is Aaron Cannon of Clear Harbor Asset Management, and his view on risk is this: the dispersion in the Fed's dot plot relative to the market continues to tighten as recent employment data, coupled with slightly hotter than anticipated CPI, suggests excessively dovish posture is not warranted. Good morning, Aaron. Good to see you. So there's Goolsbee on the tape. He doesn't support waiting until the 2% level is hit for a cut. I mean, this is where the Fed must be saying to themselves that we've gone from 7 cuts in the market to 3 cuts in the market. Job done. We can breathe a bit of sigh of relief. We've got the cover that we needed. We were just a bit too dovish, weren't we?
I think so. We came into the year and Fed funds futures, Manus, we're calling for, to your point, 6 to 7 rate cuts. And after that employment number, January employment data, we started to move towards 5. March was off the table, and now March is clearly off the table, and it looks like there's only a 30% odds that we see any movement in the Fed funds rate in May, with the first cut more likely in June. And I think, you know, if you look at yesterday's CPI data point, we missed by 0.1% month over month on core and headline, and we lost a rate cut in the Fed funds futures contract. So sort of interesting, moving towards the Fed's data point. Mm-hmm. And I think what's important is the CPI ex shelter has really increased only at a 2% annualized rate over the last 6 months. And I think the Fed is focused on that, as well as the PCE data. As we know, it's an important metric to the Fed, and that's running at a 2% rate or so annualized basis.
Then the natural question would be, when you see the spike in yields that you've had, do you think that pop to 430 has that washed out? Has that cleansed itself? Has the market cleansed itself, you think, with that reaction function that we saw yesterday, which was quite punchy on 2s and on 10s?
Yeah, I think we're probably at a point now where, extending a little bit in terms of duration in the market makes some sense. I mean, we saw credit spreads actually tighten yesterday as we saw a meltdown across the board in equities. And so, that message yesterday clearly was an inflation rate adjustment pricing rather than a growth concern embedded in the market. I mean, you just look at federal outlays, Manus. We're spending $6.5 trillion this year relative to like $4.3 trillion pre-COVID in 2019. So you have a significant amount of federal government dollars. It's an election year flowing into the system, increasing at a 40% rate relative to pre-pandemic levels. So the idea that growth is going to dramatically decelerate from here over the next couple of quarters, I think is questionable. And I think that 3 rate cut rather than 6, therefore makes a little more sense. And I think Goolsby's probably right. Of course, he's a voter and we're not. We're just observers.
We are just passers-by and commentators, and they all eventually fade. It's interesting that you talk about the tightening in credit spreads, the dissipation in the equity market, and the sort of the jolt in the bond market. And let's talk about credit. There's a lovely line in our stories this morning. The credit is the easier choice because of the economic momentum. Are you a buyer of credit relative to sovereign and equity?
So from an asset allocation and risk management perspective, we still believe that owning that sort of core treasury and U.S. mortgage-backed security component of the fixed income market is critical in the context of also being sort of long-term equity owners. Because if the economy were to trend lower, we believe equities would come under pressure due to earnings and multiple compression.
Right.
And I think treasuries and mortgages would probably outperform investment grade credit and certainly outperform high yield credit in that environment. And of course, we're very cognizant of the reality that, credit spreads are historically at tight levels. But we do own investment grade. It's just in the context of that risk management that we really believe in the correlation of assets when the going gets tough in the economy.
It's not shaping up well for the old bond boys and girls, though, is it? I mean, Bloomberg Global Bond Index down 3.5% year to date. It's looking a little bit uncomfortable. I know that 1 month and 10 days data, 14 days data does not make a trend. Is there a level of discomfort at all, do you think, in this market? I mean, they're not exactly short these bonds, are they?
Well, what's interesting is, we're almost seeing the mirror image of what we saw last year, which is to say that long duration fixed income for most of the year, or even the belly of the curve, didn't perform well. It had a bit of a rally, of course, from October into year end last year, rather significant rally. And that sort of saved the year in some sense for the bond market. But short dated, treasury bills, also, short dated high yield credit, it's up on the year. And that's because the economy's strong and the Fed hasn't moved rates. And so that was sort of the narrative for 3 quarters in 2023. It's also the narrative for the equity market, man. As we've seen, equities being driven year to date higher by these, very mega cap stocks where, the small cap Russell 2000 and frankly, the equal weighted S&P 500 is still in flat to negative territory, whereas the S&P is up by 4%. And so that was a trend that we saw last year. And that's a trend we're continuing to see this year. We'll have to see how that plays out.
What do you think of the growth scenario? Because you're a bit skeptical. You talk about restocking, inventory restocking as being one of the bulwarks, the pillars, whatever way you want to present that. Is that just healthy skepticism at the start of the year, given that everything's priced to perfection? Briefly.
Yeah, so everything does seem to be priced to perfection. We're trading at 21 times forward estimates on the S&P 500. And, you look at 2023, we came into the year, economists said 75% of economists on your Bloomberg terminal said we're not going to have a recession. So I think we need to be a little cautious. Any modest adjustment downward in the economic narrative can fundamentally, sort of alter things. And yes, I mean, the GDP data that we saw did indicate that there was some inventory restocking going on. And that could be the tale of 2 stories. If there's demand there for that restocking in the future, that's great. But if those things sit in inventory and are in that demand side is not there to the extent that those buyers thought that we would see, then that could be problematic for the economy. So we think the risk is still that we do have an economic slowdown, and maybe a modest one in the back half of the year, perhaps third or fourth quarter.
All right, Aaron, let's see how it plays out. There's still massive tail risks out there between war, between the price of oil, the resurgence of inflation. I mean, there are a myriad of left and right tail risks that can come to the belly. Let's hope some of them don't. Aaron Kennan there with his very latest thoughts on the markets coming up. The Democrats picking up a seat in the House.
Send a message to our friends running the Congress these days. Stop running around for Trump and start running the country.
Swazi's win, narrowing the GOP's already raise a thin majority. The conversation next with Anne-Marie Hordan.
So this whole campaign, the whole campaign has been about how do we communicate to people that we can be better if we work together to try and solve the problems we face in our country. And that's the message. That's the message that resonated with the people in this campaign. Let's send a message to our friends running the Congress these days. Stop running around for Trump and start running the country.
Powerful message there from the Democratic representative of New York, Tom Suozzi, delivering a victory speech following his special election win. But the Democrats taking back a seat from the GOP following the ousting of George Santos, narrowing the Republicans' majority in the House to 219 to 213. Now, the election occurred on the same day that the House voted to impeach the Homeland Security Secretary, Mayorkas, over his handling of the situation at the border. Anne-Marie Hordan is our intrepid political reporter and anchor of surveillance. She joins me now. So, can I extrapolate this early in February a win for the Dems over the Republicans, or was it idiosyncratic to New York?
So there's two things you need to look at. One issue that I think is going to be a read across throughout the entire nation is going to be immigration. If that's weighing on issues in Long Island, which is a far cry from the southern border, this is obviously going to be weighing on not just those individuals that live in states that border
it's just going to go much further up the up the roster there, isn't it?
It's hitting blue Democratic states. That's for one thing. But Tom Suozzi, what he was able to do was say, even though I'm a Democrat, he was able to put distance between him and the White House, saying the president should be shutting down the border. I agree with him on that. And he also talked about his time when he was in Congress on how he bucked some of the trends of the Democratic Party when it came to immigration. So he didn't shy away from it, even though our polling shows 6 in 10 voters in swing states lay the blame for immigration at the president's hands. So there is a blueprint, if you will, for some Democrats and potentially some tough districts to run on immigration and not have to deal with all the blowback the Republicans are putting on the president.
Well, maybe this is where the amplification, I mean, who am I to talk about political strategy? I've never run for office, but I mean, it's a big understand yet. Mind you, I can't run in this country, can I? President of Ireland is always up there.
You can't be president, sorry, Manus.
No, I know, not yet. Never. But we've got an impeachment. I mean, American politics is fascinating. We have an impeachment, of course, against Mayorkas. Talk me through that, and what does that signal?
Well, it's the second time they tried to impeach him. They didn't have the votes the first round, and which is why Tom Suozzi picking up New York 3 is so interesting, because if he was sworn in and was on the floor for that vote, the impeachment would have never went through. It went through on the slimmest majority absolutely possible on a second time around. You have to think of Speaker Johnson waking up this morning looking at his dwindling numbers of this majority he has. To get that impeachment through, Steve Scalise had to come back. He's getting treated for cancer, for blood cancer, had to come back to Congress to cast his vote to get that partisan impeachment bill through. That is what you're dealing with right now in the United States Congress. Very slim majority, and even slimmer this morning waking up in the House of Representatives for the Republicans.
Okay, well, it just shows you just how tenuous it is. Anne-Marie, thank you very much. Anne-Marie Hordan there on the politics in Capitol Hill and New York. Long Island. Haven't been yet. There's a journey. Now, for some, the sector price action this morning. Abigail Doolittle has that for me. Abby, what have you got?
Well, quite a contrast to yesterday's sell-off. Today, we have the S&P 500 up about 0.5%. Broad sector participation, industrials, all the way down to consumer discretionary, up somewhere between barely at all, up to about 0.9%. The one stock or one sector that is not higher, staples. As for a sector that's been soaring in recent days, the S&P S&P Transportation Index up about 5%. And this has to do with Uber, because Uber right now up 9%, its best day since May. Lyft up more than 30%, its best day ever, not included in this index. But of course, Uber announced that buyback, really giving that transportation index a boost.
Yeah, a nice kicker there. Abigail, thank you very much. Abigail Doolittle with the sectors for you. I'll take you through what you need to watch for the rest of the day into tomorrow. It's a beautiful day in New York. The markets are in the green. What's not to love? 49.80. Trading diary for you for the rest of the week. The Fed Vice Chair for Supervision, Michael Barr, speaks at 4 p.m. Eastern. Fed speak continues. Waller and Bostic into Thursday. Will they reinforce the Goolsbee narrative? Plus, we'll get retail sales and another round of jobless claims. Finally, Friday, San Francisco Fed President Mary Daly, and we get the PPI numbers. That was Countdown to the Open.